Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Jonathan Hayek. While working as a public school teacher, Jonathan began investing in real estate with only a few dollars. Through grit and creative strategies, Jonathan flipped single-family homes and built a portfolio of small multifamily properties. Now using real estate to fuel his lifestyle of family time and playing in the mountains, Jonathan now invests in larger commercial assets, preferring net leased industrial properties. He enjoys inspiring others, speaking about the freedom that real estate can provide, traveling and ultra running as well. Jonathan, welcome to The Wealth Flow.
Thanks for having me, Keith. I am thrilled to be here.
I'm thrilled to have you. And I'd like to start maybe with just your background on where you grew up. And obviously you went to teaching initially and then eventually to real estate. So tell us a little bit about what led to that journey.
Sure. So I grew up in Naperville, Illinois. It's a western suburb of Chicago, about 30 miles west of Chicago. Great place to grow up. Very fortunate to have grown up there. Went on to college at Illinois State University in Normal, Illinois, majored in special education, became a special education teacher, got a master's degree from North Central College in Naperville, and thought I was going to be a school principal because I had this idea from early on in my working career that I wanted to make good money on the one hand, yet on the other hand, I was a teacher. And making good money and being a teacher generally don't go hand in hand. And so I thought, well, how can I make a little more money while staying in the education field? I thought I was going to become a school principal. So got a master's degree, thought I was going to become a principal, maybe a superintendent of a district, something like that. And as my teaching career went on, I just realized that I was going to continue trading time for money, that principals and administrators, they work a ton of hours. And they do make more money, but man, do they work a lot of hours. They also don't get summer breaks. And so as I was teaching, I just thought, man, there has to be another way that I can continue to build my income. And so I started flipping single-family homes, and I used the proceeds, my single-family homes, to buy small multifamily properties. And the idea was I thought I was going to build this portfolio, this empire of small multifamily properties, duplexes, triplexes, fourplexes. And then I eventually got up to about 22 or 24 units and was like, wow, this is a lot of work, all these tenants. And I was, of course, self-managing. And so it was just a lot of work. And I thought, well, I love real estate, but I wish there was something more passive about real estate. All that passive income stuff just is not true. And so I started experimenting with some non-residential real estate. So I bought a vacant office building, leased up that office building. And then now I am focused on other non-residential assets. I own a couple single-tenant industrial properties. Those are on the small side. They're about 10,000 square feet, a little under 10,000 square feet, single tenant and triple net leases. So the tenant takes care of almost everything with that property and creates a very easy to manage property for me. And so really focused on continuing to build my non-residential portfolio. There might be some more residential properties thrown in there, but really looking to use real estate to maximize on my lifestyle desires. And like you mentioned in the intro, really enjoy spending time with my family, and I live in the mountains in Colorado, so enjoy spending time outside. I don't want to have traded my W-2, working 40 hours a week, and a W-2 for working 60 hours a week on my own. And so really like to continue to build the passive rental income as I go.
Okay. Yeah, that's a very interesting background for sure. And I love the kind of recognition that you're going to just, if you continue to stay in the teaching, you're going to just be trading your time for your money. I think that's sometimes something that gets overlooked, but good to see that you were able to find that. And so take me to today. You've left your teaching job at this point?
Yes. Fortunately, I left about 5 years ago in 2019. So just before COVID hit. My wife and I decided that we were in a spot good enough with our real estate that we could take the plunge and quit my W-2. And we started having kids shortly thereafter. And so it's been, we can go into some of the strategies I use to quit my W-2. But yeah, it's been just exactly 5 years now that I've been real estate full time.
Okay. Congratulations. That's a huge deal. Tell me a little bit maybe about the mindset too of being able, sounds like your wife was on board with that vision as well, but tell me a little bit about, kind of the decisions and did you second guess yourself at all after you left or, tell me a little bit about how that went.
I never second guessed myself, and I can tell you a little bit about the thought process because I know this is a popular topic that people would love to be full-time real estate investor and quit their W-2. And so I can tell you a little bit about how I did it. And I'll first start out with a caveat that we had no kids at the time. And so I think it does change things. If I were to have to start over right now I have 2 little kids, and it would just be a very different mindset if you've got kids. And so I want to recognize that it is definitely a challenge if someone has all the challenges and different complications that having kids brings. And so I had a particularly bad school year, the 18-19 school year. It was just a hard school year. And so my wife and I planned about 5 or 6 months in advance. At this point, we had some rental income coming in from some duplexes and fourplexes. We were also actively flipping single family houses. And so these flips were coming in before taxes. We would make 40 to 50 grand per flip, and we'd be doing a handful of these per year. And so we started to get some momentum. And then we also had not enough, but we had some rental income coming in. And so it was really just a calculation. And one book that was instrumental in this process was Scott Trench's book called Set for Life. And one strategy that he has in there that was really helpful for us was to have a runway fund. And a runway fund is basically mapping out your expenses for the next, say, 6 to 12 months. We chose 12 months. We said, okay, our expenses over 12 months are roughly $50,000. That's all in our housing, living expenses, everything. So we said, okay, what if we set aside $50,000 in a separate bank account and I quit my teaching job, and that $50,000 is going to be what we use to live on for the next 12 months. That gives us a runway to see if we can make this real estate thing really work. We wanted to continue to buy more small multifamily properties, continue to flip houses, but there's always this thing in the back of your mind like, well, what if the market crashes? What if What if I stop getting deals? What if I think I can get deals, but I don't? What if I start losing money on deals? What if I think I'm going to make 50 grand, but I make 10 grand? And so, using that runway fund was just like, we've got 12 months to see if we can make that work. And I can pause there in case you had a follow-up question.
Yeah, that's neat that you laid it out that way, and I guess kind of using the framework from Set for Life with that runway fund. That's good. That's good. And so you looked at that and you said, well, we can continue to flip some homes along the way as well, right? And we've got this $50,000 sitting here. So worst case, I guess, scenario, after 12 months, you just go back to teaching if you can't quite take off on that. Is that kind of what approach you looked? Was your wife, I guess, working at the time, Jonathan?
My wife was working. She has worked in the past for non-for-profits, and so her income has not been, her job has not been a huge income generator for us. But you're exactly right that, a book that was helpful for us for that was Tim Ferriss's 4-Hour Work Week. There's this exercise in there where he's like, just if you're considering something like this, go through the worst case scenario. Actually write it out in a list. What is literally the worst thing that could happen? And when we got down to it, the worst case scenario was, okay, 12 months, the real estate thing didn't work out, or it's not working out like we thought it would. I still have my teaching certificate, so I can just go back to teaching. And so we thought, you know what, if that's the worst case scenario, it was a risk we were willing to take, and we fortunately did not exhaust all of our runway fund, and I did not have to go back to teaching, and the real estate full-time did end up working out for us.
Good. Yeah, that's neat. It's neat that you had those couple things to lean on to kind of give yourself that basically the strategy and the plan to be able to do it. So you had these multifamilies, you were flipping some homes. Tell me, I guess, a little bit about the multifamilies. How much were you making on these multifamily after bills and all that stuff?
I've always been a value add investor. And so it was simply a requirement to buy deals that were below market value with rents that are below market and the units needing some work. So, I don't really have cash on cash metrics. I guess if I were to ballpark it, they generally fall in the 15 to 20% cash on cash return range. But sometimes the cash on cash metric isn't super helpful, because if you're buying value add deals, I was burring these. And so, I'd add value, but then I'd refinance. And so then I'd take a bunch of my money out. And so, in some cases, I didn't have any money in these deals, but they were still cash flowing. And so, a lot of times it was like a per unit metric that I would want. So these would generally cash flow between $250 and $500 per unit. And so, for example, my first duplex that I was so excited about, I bought, it was technically on market. It had a sign out front, but I couldn't find it on Zillow or realtor.com anywhere. So I tracked down the agent, and the agent said, "Oh yeah, that property. I've been meaning to put that up on the MLS. I just haven't gotten around to it yet. Do you want to look at it?" So this was a duplex that I ended up buying for $150,000, and it fit the 1% rule. So the 1% rule is the monthly rents should be, it's just a general rule of thumb. Monthly rents 1% of the purchase price. So if you're buying it for $150,000, are the monthly rents $1,500 in total? And in this case, they were over $1,500, and so it was better than a 1% deal. It was like 1.2% deal, and so that's another metric that I used early on. Just quick and dirty, back of the napkin math. Is this deal worth pursuing? And so it was those types of deals. So it was that duplex. Then I bought another fourplex that was in a really similar position, was able to rehab some units, raise rents, was able to buy an eightplex. I still own that eightplex, and just bought a bunch more small multifamilies, just exactly like that. And then when interest rates were good, I could add value, refinance, take a bunch of cash out. It would continue to cash flow, and then keep the snowball going from there.
Yeah. And what area were you investing in? Where were you finding most of these?
At the time, I was living in Cheyenne, Wyoming. So Cheyenne's a fairly small town, about 60,000 people. But I was able to create a bit of a competitive advantage there, and was able to build a little bit of a portfolio there.
Great. It seems like Wyoming overall is growing at a fairly decent rate.
Wyoming is a big, goofy state. Cheyenne, 60,000 people. It's the largest city in Wyoming. It's the state capital. Cheyenne itself is growing pretty nicely. It's got a lot of things going for it. And so Cheyenne, continues to be a pretty good place to invest. I'm not super active there anymore. I'm still doing a little bit, but sometimes with those small towns, competition, compounds exponentially. And so, you get like 5 more flippers in a small town, and then it becomes pretty saturated pretty quickly.
Right. Yeah, makes sense. And so from those, you continued to burrow them, you said, and hold on to them, and then from there, what is that when you got into industrial after that? And is that investment in industrial in the Wyoming area, or have you moved to a different area at this point?
Yeah, so my portfolio really started to transition. And so I had this portfolio of, approximately 22 units. And it became a calculation of what is my return on equity. And so return on equity is a metric that I like better than cash on cash, because it's better for value add deals, because a lot of times we're refinancing our capital out, or we're paying off investors, and it's sometimes hard to know how much money do I have in this deal. And so return on equity is basically, what do I owe on this property, and what would it sell for on the open market? And so that determines how much equity you have in the property. And then you can figure out, well, what am I bringing home each month, and then annualize it. And so then you can calculate your return on equity when you divide your take-home income divided by how much equity you have. And so when I did this exercise for some of my small multifamily, the returns turned out to be a little lower than I was wanting. For some of these properties, my return on equity was only in like the 6 to 8% range, and I was thinking 6 to 8%, that's okay, but I think I can do better. And so some of those lower performing properties I decided to sell. And so then I took those lower performing properties, and then it's also kind of a calculation of more of a qualitative calculation of kind of the pain in the butt factor. Because, we've all had those properties where it's like, okay, I'm making a little more on this property, but for some reason, it's just a pain to operate. It attracts bad tenants, or stuff just keeps going wrong, or it's an older property, or, whatever it is. I know I'm going to have to do a furnace or a roof in the next couple of years. And so, all those factors go into this decision. And so I decided that, a handful of these properties I was going to unload, and I wanted to get a little more passive. And so my first non-residential deal was this office building. I thought that was a step towards a little more passive investing. And it sort of was, sort of wasn't. I learned a million lessons on that office building deal. Did okay on it, made money. Most importantly, learned a ton of lessons. Held that office building for about 18 months, sold it, and then was able to take the proceeds from that and deploy them into another asset. And so I own right now, in the last year, I've added 2 single-tenant industrial properties. One is in Oklahoma City, I don't have any affiliation with Oklahoma City, don't know anyone there, never lived there, found a deal. And so that's why I bought that. And then I have another single tenant industrial property that's back in Cheyenne, Wyoming. That was a completely off-market purchase. Purchased that just purely through a broker connection. And both of those properties have a single tenant with a tenant that wants to stay long-term. And those are net leases. And so if your audience isn't familiar with that, be happy to go into some of the benefits of a net lease. But, largely the tenant takes care of most of the expenses for those properties, and they take care of the property really well, and they want to be there long term.
Yeah. Maybe for the benefit of the audience, if you want to maybe share a little in depth. So when you say take care of the expenses, what does a landlord typically have to cover from an expense standpoint, and what is the difference when we start looking at triple net?
Sure. So I'll contrast it with residential properties, which many listeners might be more familiar with. So typical expenses in, let's say you've got a duplex or fourplex or a mobile home park, you've got taxes, you've got insurance, you've got maintenance and capital expenses, landscaping, snow removal, things like that. And when taxes increase, like they are in so many places, when insurance increases, like it is basically everywhere, you as the landlord have to cover that gap, so to speak. And so you have to pay the increase in insurance premiums, but you don't necessarily get to bill your tenant back for that. Your tenant is kind of paying you for those expenses, but if your insurance goes up $1,000, you're not necessarily collecting an additional $1,000 that year from your tenants. However, on the non-residential side, a lot of these leases are net leases, and you may have heard the term triple net lease or double net lease. And so the nets in commercial real estate are taxes, insurance, and common area maintenance. So what this means is oftentimes in these single tenant properties, like in my single tenant properties, the tenant is directly responsible for paying taxes, insurance, and maintenance. So for example, I own this property in Oklahoma City. It's a little flex property. It's about 9,000 square feet. It's about 1,500 square feet of office. In back, there's this warehouse section, and the tenant is a landscaping company. They have a 5-year lease. And of course, every year we have property taxes to pay. I don't receive that property tax bill. That property tax bill goes directly to the tenant, and the tenant pays that property tax bill directly. They are also responsible for paying the property insurance bill directly. They also are responsible for taking care of when the grass needs to be cut, when there's snow, when light bulbs need to be changed, any typical maintenance, paying utilities. If they want an office painted, the tenant is responsible for that. And so when property taxes go up, the tenant pays it. When insurance goes up, the tenant pays it. And so I don't hear anything about it. The tenant is responsible for it directly. And so that's why these types of properties with these types of leases are especially attractive to people looking for lower management and more passive returns.
Okay. Fantastic. And what you said you got a landscaping business. That's one of them. Give me an example of maybe the other tenant.
Sure. So my other tenant in Cheyenne is a glass manufacturer. So they manufacture windows, shower doors, car windshields, things like that. They've been at the same location for over 40 years. The landscaping company has been at that same location for over 20 years. And so one of the benefits of these types of properties is the tenants are sticky. It's not like having a 1 or 2 bedroom apartment where the resident is there like as a stopgap until they get a new job or until they get married. These businesses operate here long term. They're responsible for employing people and people's livelihoods, and oftentimes it's also a retail center, and so they they want to have a solid location so that customers can come in and customers know where to find them. And so these are long-term locations and long-term investments for these tenants because they want to have clarity and to know that they're going to have a place to run their business long-term.
Yeah. And with future ones, are you still looking in that space to continue to buy additional ones, Jonathan?
Absolutely. For all the reasons that I mentioned, I would love to continue to build this portfolio. And my strategy here is also value add. And so I look for properties with expiring leases, with rents that are below market rate, and a tenant that wants to stay. And so that way I can buy at a great deal and I can sign the tenant to a long-term lease with nice rental escalations. And these deals are hard to find, like a lot of great deals, like great mobile home park deals, like fourplexes and even larger multifamily. These deals are hard to come by. But once you find them, they're a great asset to hold on to.
For sure. And how are you going about finding these deals?
Various ways. I mean, I've got alerts set up on search engines. And so, Crexy, I'm checking Crexy frequently. And then also just using my broker connections. The one deal in Cheyenne came off market. I had just sold a couple properties with this broker. And so I told this broker, hey, I'm looking for, this is my criteria. This is what I'm looking for. He came back to me the next day and he's like, hey, that B&W glass building? I think that's available. Are you interested in that? I'm like, yes, actually, I am interested in that. And so, it's tough out there. There's a lot of competition. There's a lot of capital. And these are attractive properties for a lot of investors because they see the opportunity with it and kind of the passive nature of them. So like a lot of great deals, they're relationship based. They are, it's figuring out a way as you craft offers to develop some sort of competitive advantage, whether you're closing with cash or you're waiving some contingencies or you're being especially easy to work with. Those are some of the strategies that can land you a great deal.
And tell me a little bit about how you're structuring these deals. What kind of a purchase price are we looking at? And then, how much a loan to value are your loans? How much are you having to put into it? We talked a little bit ahead of the show about, potentially structuring it with some private money. Tell us a little bit about that.
My bread and butter for a lot of the deals that I do are utilizing local banks. So even the fix and flips that I've done in my past have been financed with local banks. And so a lot of these properties, these are not like Fannie and Freddie aren't interested in these deals. Life insurance companies are not, for the most part, are not interested in these deals. These are local banks. This is the bank around the corner. That knows the area, maybe knows the business owner of the tenant. And so the deal I closed in Cheyenne, the purchase price was $1.2 million. It was a 1031 deal. And so I was bringing cash from another deal that I had closed. And so I think I brought about $425,000 down. That's going to come out to putting down 35%. That's not typically with local banks. These are like 75% loan to value deals. And that was the amount of money in my 1031. And so that's the amount that I put down there. And bank was happy to get a little more of a down payment from me. This other deal in Oklahoma City, I ended up paying with cash. And that was one of my competitive advantages that I used to get this deal. I was actually not the highest bidder, and the broker told me that. But the seller ended up going with my offer because it was cash, and I didn't have bank financing to essentially screw up the deal. Because a lot of these deals that I buy they're a little hairy, and with expiring leases like this one had, banks are sometimes not real comfortable with expiring leases because they fear vacancy. But if I can say, hey, I'm going to close with cash, it's not contingent on financing, that can be really attractive to a seller. And so I brought some cash, and then I got some friends and family together and they brought cash too. And so the purchase price for that one in Oklahoma City was $750K. And I brought some 1031 money, and then I also brought money from friends and family. And typically, when I structure deals, I've been using private money from friends and family since the very first deal that I did, because like I told you, I was a teacher. I don't come from money. My parents, still to this day, have never invested with me. They have never given me $1. I don't come from money. My dad was a teacher. So, my parents don't have money. And so, I really bootstrapped this thing, and I've been working with friends and family. And so typically what I do is I offer like a set, it's essentially a debt deal, and my friends and family act as a lender. And so, like for the first deal I ever did, it was a friend, and he said, I'm willing to lend on this, but I want a promissory note and a mortgage on it, and it was going to be filed with the county. I'm like, well, I don't know how to do that. And so I talked with an attorney and explained what I wanted to do. And so I had an attorney draft up a template of a mortgage and a promissory note. And so then I used that with my friend, the lender, and we filled in all the blanks, and then we filed it with the county. And so it became a lien. And so I couldn't sell that property without paying my friend back. And so it's, one of the most secure ways that somebody can possibly invest. And I have done probably 25 or 30 more of those types of deals. And I'll add the caveat that I'm not advocating that this is the right way to structure deals. I'm just sharing my experience and what's been helpful and has been beneficial to me in the past. And so I still structure deals this way, where my investors are actually a lender, and we do a promissory note, and depending on the situation, also a mortgage that gets filed with the county, so that I can't dispose of the property without the investors getting paid off.
Yeah. Yeah, I think that's a good way to do it. It does allow you the flexibility to have a little bit more control over it. And in turn, for your investors, it truly is tied to the property, especially with the promissory note. Are those long-term when they're going in, or do you have a goal of refinancing at a certain point to be able to get them back out of the deal? Or is it just kind of on a case-by-case basis?
It's on a case-by-case basis. Early on when I was flipping houses, there's always, it's like a 3 to 6 month exit strategy. Get in, do your rehab, and sell as quickly as possible. It's also a conversation with your investors. What are you looking for in investment? Are you looking for a long-term investment where you don't need the money for years and years and you don't want the money back? Or, is this more of a short-term, 12 months or fewer? And so it's a discussion with your investors, and it's also a business strategy, because these are typically higher rates than you would pay with a bank. And so you have to look at your numbers and see what makes sense for you. So this Oklahoma City deal, I was hoping to be able to refinance my investors out of it within 6 months of purchasing it. With interest rates being what they are, I wasn't able to execute on that. And so I had a conversation with my investors and said, hey, this is the state of the debt market. I can pay you off and, through various ways. But if you don't want to get paid off, I'm happy to continue to pay you if you don't need your money. And so they said, yeah, we don't need the money. We're happy to continue getting monthly interest payments. And so that's how that discussion goes.
Okay. And then at some point, hopefully we'll have lower rates, but doesn't look like for the foreseeable future. So on these local banks that you've been using, are you out searching for specific banks, like interviewing different banks and saying, hey, I've got this potential deal, here's what it is? or are these banks that you've had an established relationship with before asking them to fund it?
For the most part, I am working with banks that I have done multiple deals with before. In some cases, with one bank, I've done probably 20 deals with them before. And so, real estate is such a relationship business. And, you get to a point, I'm at a point with one of my bankers where I can send him an email and say, hey, I got this deal. Here are the numbers. Are you interested in lending on it? And he emails me back. He's like, yep, sounds good. 30-day close. All right, we're in. And so, he might ask for, a little more paperwork after that point. But it is so important to build your reputation and build your credibility and do what you say you're going to do and overperform and over-deliver so that investors and bankers know that they can count on you, and they just know that they don't have to worry about you because they have plenty of other people and clients that they have to worry about. And so if you can be that one person that the bankers can count on, it will be so helpful for you on future deals because, they'll be able to close fast and, make things kind of hassle-free for you in the future.
Yeah. And where do you see your business going over the next, say, 5 to 10 years?
What a good question. I want to continue to build the portfolio and I want to continue to build my skill set. And so I continue to love industrial properties. I love single-tenant industrial. I'm open to multi-tenant industrial properties. I'm also open to retail properties. There will probably be some residential deals thrown in there as I continue to be opportunistic. I literally just got a call today on a potential residential deal. I haven't marketed residential deals in at least 2 years, and I still get phone calls for residential deals. And so I'm sure there's going to be some things that come up. And so I want to continue to be opportunistic, but also aware of that I'm using real estate to fund my lifestyle. I'm not trying to be a billionaire, but I am trying to build a portfolio that's going to support my family and my lifestyle in the long run.
Yeah. And tell us maybe a little bit about that, Jonathan, your lifestyle. When you say lifestyle, what are the things that real estate's and the income that's coming from it are going to allow you to be able to do that's maybe different from, say, somebody with a traditional W-2?
For me, it's all about freedom and specifically time freedom. And, I could probably work 50, 60, 70 hours a week and build my business to be huge and syndicate tons of deals and take fees from investors and create a business just based on fees. And some of the deals will do well. But, that is a lot of what a lot of syndicators are doing. And they build their business based on fees and just simply based on volume. And meanwhile, they may not have great family relationships or personal relationships. They may not be healthy. And that's not the life that I want. I have no interest in that. I have no interest in being transactional and just looking for the next deal and having some desperation to have the next deal and collect fees so that I can pay the bills and keep my secretary and things like that. It just seems like a flywheel that I don't want any part of. And so I really value freedom. And so I can, have breakfast with my little kids and drive my daughter to preschool in the morning. And, you mentioned in the intro, I like to run in the mountains and I run ultra marathons and it takes a lot of training. And so I can go out and run in the mountains for a couple hours on a Tuesday afternoon. And when it's snowing, I can go, I can go ski powder on a Wednesday morning. And, there's certainly some work involved. And I don't want to say that I don't ever work, but I want to be able to have the freedom to take those special moments with my family, to be able to travel and take advantage of unique travel opportunities and live in a place that I love, while also using real estate to fuel all of this. And I will grant that I'm probably leaving some money on the table. by not working 50 or 60 hours a week. I could probably be wealthier. I could make more money, but I would be sacrificing so much other stuff at the same time. And so not everyone's going to agree with me, but that's where I'm at in my investing philosophy.
Yeah, I like it. I like it a lot. It can give you an opportunity to do some of those things. And like you said, it's not like you're not working. You have the flexibility to do the work side of things when you want, and you can take advantage of opportunities for that fresh powder, skiing or whatever it may be. And so, yeah, that's great. What do you manage all your own properties, or are you doing third party on, say, the small industrial single tenants, or what does that look like for you?
Yes, I still own one 8-unit apartment building. That's about 3 hours away from me. I still self-manage that. And then my industrial properties, even my property in Oklahoma City, I self-manage because there's so little to do with those net leases. And so they're really great properties for self-managing. I can check in with the tenant, every month or every quarter, make sure everything's okay. I can visit the property when I'm in town, but with the net leases, there really isn't any day-to-day management requirements.
And you've had quite a journey on the different types of real estate. So I just would be curious, are there any specific lessons you learned with the various asset classes that you want to share with the audience? For instance, anything you learned while you were flipping, how that compares or is different from multifamily and now into the triple net industrial single tenant.
One of the biggest lessons is about knowing how much money you're making versus how much money you're taking home. So from flipping, a lot of flippers, I was certainly one of them, you think you're making a bunch of money. You close a deal and you get that check at the title company and you get $50,000 after everything's been paid off. And so that's great. Hey, I made 50 grand. But then you have to file your taxes. Right. And you realize that flipping is a business. It is a real estate business, but it's not really investing. It's running a small business, and it is a high tax business. And so, you're paying ordinary income. And so if you're making a bunch of money, it could be 40 or 50%. And then on top of that, if you're not structured effectively, you're paying another 15% in small business tax. And so I had a couple really good years of flipping that, and I would get really aggressive on redeploying my capital into buying more assets. And I had a couple years where I had a tax bill that I could not pay. I didn't have a plan for paying it. It was an unexpected 6-figure tax bill that I really should have been prepared for, but I wasn't. And so, it took some creativity to get the tax bill paid. And so from then on, it's not that I will never flip another property, but it's being aware that there are some strategies that you can utilize to reduce your tax bill if you're doing some of those short-term strategies, but also understanding that it's not just totally what you make or what you think you're making or what's on the spreadsheet, but how much you're actually taking home after taxes. And so that's when the long-term assets come into play. So keeping things for more than a year, using things like real estate professional status, using things like cost segregation, and using all of these tools and putting everything together to make real estate, be the real wealth and income builder that it can be.
Okay. And what about one of the things that oftentimes when I'm talking with friends of mine who are kind of taking that step of leaving a W-2, for instance, especially having children, what are some of the options or some of the things that you've had to kind of strategize about when it comes to, say, health insurance, that kind of thing?
So I can just share my experience, what we did, and not saying everyone should do this, but it was all part of the calculation. And so I'm still self-employed. I still don't have true health insurance. And so our medical expenses just go into our annual numbers. When we calculate our expenses, how much money do we need? There's a line item for potential medical expenses. And so what we do have is like a med share co-op kind of thing. And so it's not true insurance. It's like, I don't know what it is. I think it's called a medical co-op. It's this Christian ministry thing where it acts like insurance. You pay a monthly fee. It's a high deductible. I think we have a $10,000 deductible, but pretty low premiums, and it's essentially a catastrophic kind of thing. And so part of our strategy is continuing to be healthy. And so we really try to take care of ourselves. And when I'm skiing, I'm not taking huge risks when I'm skiing because I know, a broken leg, going to the hospital for a broken leg or, ACL surgery is going to be a huge cost. And so, that sort of thing goes into it. And I imagine we could go back to the insurance marketplace and make some other calculations and potentially get true medical insurance. But it is definitely, we can say all kinds of things about the medical system and the insurance system in this country. And, small business owners are at a real disadvantage when it comes to insurance because when you're a W-2 employee, you don't really realize how much insurance costs until you go the self-employed route and you start pricing it out yourself. And there's a shock and awe moment when you're like, oh, I'm just going to go sign up for insurance. And you realize it's like $1,200 for a family of four. It's like $1,200 a month. And you're like, oh my gosh, how's this going to work? When that's, not expected. And so, there are things like that just, you need to do what's right for your family. And maybe it's paying that premium yourself. Maybe it's doing something more creative. Maybe it's self-insuring. Maybe it's one spouse keeping a W-2 in order to have benefits. Maybe it's getting a part-time job at Starbucks in order to have benefits through a generous employer like that. And so, there's all kinds of solutions and, everyone just needs to, figure out what's best for them.
Yeah. One other question I have, maybe with respect, and there may not be parallels, there may not be something that you can, take away from this, but just curious if there's any lessons, that you've learned from even just the ultra marathons that you applied to your business strategies and that kind of thing. When I think ultras, I just think of, man, long distance. And it's a different mindset, when you're going out for a 5-mile run or if you're going out for a 50-mile run, totally different.
Absolutely. And I think about this all the time when I'm out running because, an ultramarathon is a run of more than 26.2 miles. And so like this weekend, I've got a 50-mile race. It's going to take me somewhere around 12 hours to finish this race. So I've got a lot of time out there to think. And so really the biggest parallel between ultra running and real estate investing is thinking long term. So if you've got a 50-mile race and that start gun goes off, you are not sprinting out of the starting blocks. You're there all day. It is a slow and steady process. And so if you want to have success on that day, you've got to pace yourself. You've got to keep your heart rate low. You've got to do all the right things like drinking enough water, taking in enough salt, and having enough electrolytes and energy and keeping cool, putting ice on you, all that kind of stuff. Well, it's really similar to real estate investing. You've got to be in it for the long haul. If you think you're going to get a big win right out of the gate and you're going to make millions on your first deal or the first couple months and you're just going to burr this and make tons of money, you can maybe have some home runs, but for the most part, real estate investing is a long-term strategy. And you're not going to win. You're not going to win on day one or month one or even year one. But if you stay with it long term and you do the right things, like like investing in capital expenses and taking care of your tenants and making sure your tenants are happy and having the right types of leases and maintaining broker relationships and making sure your building looks good with landscaping and just doing the right things, you're going to be rewarded long term. So I think that's one of the big lessons that I take from distance running.
Yeah, that's great. Really, this has been very good, Jonathan. How about where people can find out more about you if they'd like to see? I don't know if you post on social at all as far as your real estate stuff, but tell us a little bit about it.
Sure. So when I was trying to learn how to invest in non-residential commercial real estate, I couldn't find anywhere to learn. And so I created my own podcast so that I could learn about this stuff. So I have a podcast called The Source of Commercial Real Estate, and I interview experts in office, retail, industrial. I interview investors, brokers, attorneys, all kinds of people with expert knowledge in their specific niche in non-residential commercial real estate. So that's called The Source of Commercial Real Estate. I'm also probably most active on LinkedIn, and so you can find me on LinkedIn as well.
All right, fantastic. Well, I've enjoyed our time together, and I've got 2 more questions for you if you have just another minute or so.
Sure, absolutely.
The first one is one I ask every guest. Actually, the next 2 questions are what I ask every guest. But one of them is just, any advice you might give somebody who's just starting out in their investment journey.
It's okay to start small. If you spend any time on social media, there's going to be this pressure to 10x and go big and syndicate and raise money. And I would push back against some of that and just say it is okay to start small. Focus on having some success, building your track record, build your reputation, learn your lessons on small deals so that when you get to the big deals, you are ready and you've learned the lessons that you've needed to learn, and you can proceed with confidence when you're ready to raise money from investors and get lending from banks. And you learn so many crucial lessons on those small deals, and it is way easier to take a tough lesson on a small deal than it is on a big deal.
Yeah, that's great advice. I love it. And then how about any book recommendations? Doesn't have to be real estate related, but it certainly can be. Just something that's been impactful that you've read recently. You've already shared a couple good ones, but
yeah. So I already mentioned a couple: Set for Life and 4-Hour Work Week. I'll throw in a couple others. These are kind of higher level books, but really interesting. So Steve Schwartzman, the founder of Blackstone, the biggest investment company in the world, has a book called What It Takes. And then Sam Zell, who has now passed away, but he was worth billions of dollars when he died. He wrote a book called Am I Being Too Subtle? Those 2 guys started some of the biggest real estate investing companies in history. And those 2 books are really honest, and they just outline exactly, what it takes and some of the sacrifices they made in order to build these massive companies. And it makes you reflect and think about, am I willing to do some of these things that these guys were willing to do, like, not seeing their kids for long periods of time and having messy family lives and messy personal relationships, just in order to build this huge business. And so those were 2 great books that I've read recently.
Great. Yeah, I love Am I Being Too Subtle? Have not read What It Takes, so I will put that one on my list. And Jonathan, this has been great. I think we'll call it a show. Thank you so much.
Thanks for having me, Keith.
Yeah, thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.